starting, let me again introduce to you our distinguished speakers. Mohamed, you already all know him very, very well. So Mohamed is the Managing Director, Treaty Division at UIB, a broking firm, which is one of the prominent broking firms throughout the world, and he's also the Managing Director of the Middle East. He works, before UIB, he worked at Egyptry, and lots of you know him from his roots in Egyptry. And he holds a Bachelor of Economics, Business Administration from the American University in Cairo, a Master's in Science in Insurance and Risk Management from Cass Business School in London. He's also an associate of Chartered Insurance Institutes, as well as an accredited director and board member by the World Bank. Thanks, Mohamed, in joining. Well, speaking about reinsurance, maybe we can turn on Mohamed, and we'll have a presentation more on the P&C side and the reinsurance of it. Dear Mohamed, the floor is yours.
Mark, thank you for the introduction. Mazen, thank you for the presentation. It's always a challenge to present after Mazen, and I've been put in this situation before, but I'll try to keep up. Thank you all very much for being here. It's always very special for me on a personal basis to be in Egypt. It has a very special place in my heart, and it's always good to be here. So I've been asked to present this theme from the point of view of the reinsurance, and that's what I'll try and do, focus on the reinsurance side of the business and how that's changing. To do that, I thought I'll focus on what I think are the main themes, that are the main key trends that will be impacting the future of the reinsurance industry. And here there are a few of them, of course. I've chosen to focus on those 5, which I'll be going through in the presentation. Number 5 is really the last one, but in a way it's the most important in my mind, which is the automation and the adoption of technology. I think all the other themes are going to be very much impacted and influenced by the technology. And I was very happy to see in the opening speech the fact that the regulator is putting huge emphasis on technology and how the Egyptian market really needs to catch up on that side of the business. Without it, we're not going anywhere, and as Mazen just said, it's already here, it's just a matter of us adopting it. We'll start with the first theme, which is the capacity versus value-added services. I think the market is changing. The role of the reinsurance broker and the reinsurance underwriter is both being challenged, and the general trend is it's becoming clear that just providing financial capacity or just providing transactional services is no longer sufficient. We're seeing insurance companies globally are getting larger, more capitalized, more sophisticated, partly also because of the regulation, and therefore in general, we're seeing less of a need for reinsurance capacity. And therefore, reinsurers are now not just simply providing capacity, but are focusing more on providing earnings protection and capital protection for their clients. Same thing with the reinsurance brokers. We still provide our main core service, which is on the transactional side, getting you the best terms and conditions. However, it's becoming very clear that we need to branch out and focus more on the advisory services. And here are just a list of some of the advisory services that the brokers and also the reinsurance underwriters are offering their clients. And I think underwriters that will continue focusing on just pure capacity will be left behind. One of the other key trends that I think will continue, and we've already been seeing it over the past years, is the mergers and acquisitions. I think that trend will definitely continue and grow, and it will create larger global reinsurers. The rationale from the reinsurer's point of view is the larger they are, the better position they are to defend their margins and and influence the pricing, and as well as having more flexibility in allocating their capital in different lines of business and different territories. Of course, that will create another risk, which is even further concentration of the business with the big players. As you may know, we already have a very high concentration of reinsurance, both in the life and the non-life side. In the life industry, the top 10 reinsurers control over 90 or even 95% of the market share. If you look at the P&C market, we have over a 65% market share concentrated with the big 10 players. And if that trend continues, we're going to see more of a concentration. We also expect to see a change in the partnerships between the insurance companies and the reinsurers, whereas before the placement maybe was fragmented with so many players. It is my feel that a lot of the larger insurance companies will then prefer to work maybe with a more limited range of reinsurers who can help them across the whole range of lines of business and territories. And of course, that raises the question, where does that leave the specialized reinsurer or the monoline reinsurer? We used to have a lot of monoline reinsurers, for example, writing purely nat cat business, but I think, and that's still the case. However, I think the future will better serve the more diversified and larger reinsurance companies. One of the other interesting trends that we're starting to see is the blurring of the roles. I think in the past it was very clear what the broker's role was, the insurance company and the reinsurer, but I think in recent years we're seeing a bit of a blurring. Many of the parties are assuming or trying to get involved in the areas of the others. If we look at the insurance companies, we have seen a trend of many insurance companies buying reinsurance operations. We have the example of AXA buying Excel, AIG buying Validus, and this shows that the insurance companies are keen to enter into the reinsurance space. Brokers also are moving into more of an underwriting role through the creation of MGAs or having the facilities or binding authorities allowing them to play a role that was previously assumed by the insurance or the reinsurer. Reinsurers as well are moving more into the direct insurance market. Many people are not aware, but if you look at the big global reinsurers, take Munich Re for example. Munich Re's income today is almost 50% emanating from direct insurance business. Swiss Re, in recent years, with Swiss Re Corporate Solutions, have been expanding more on the direct business, which I think is in the range of 20%. And there are many examples. And this also creates more of a balance for them and gives them more control over the original pricing. And of course, we have insurtechs that are coming in that are disrupting all of the other stakeholders and are allowing many of those stakeholders to branch out into lines of business and into parts of the market that they were not previously involved. Alternative capital. I personally think this is going to be one of the biggest influencers and shapers of the reinsurance market. Alternative capital basically is a wide term used to refer to all capital going into the reinsurance market that is not coming from the traditional reinsurers. This has been around for a while, and I'm expecting it to continue to grow. Why do these investors come in? These are usually financial institutions or pension funds that are now dedicating a very small percentage of their investments into the reinsurance market. And one of the main advantages that they get is that the reinsurance exposure, especially on the nat cat element, does not correlate with any of their other exposures. So you can imagine if you have a financial investor who is investing in stocks, instead of investing in all kinds of financial assets, when there's an economic crash, all these assets are impacted. However, that does not increase the chance of, say, an earthquake happening in Japan. So it provides a very nice diversification for those companies. There are different kinds of alternative capital, the way they are sold to the market. We don't have time to go through all of them, but they are on the rise. Okay, so what's going to happen to alternative capital in the future? There was a very big question on whether or not it was going to be a stable and long-term presence in the market. Many thought that as soon as the interest rates rise, alternative capital will disappear. That's not been the case. I think it's here to stay, and it's probably going to grow further in years to come. We're now estimating that 15 to 20% of the reinsurance capital is coming from alternative capital, and particularly the retrocession market, which is very much dominated by nat cat, property nat cat. It's almost 50% of the capacity is now coming from the alternative capital. So far, it's only been focused on nat cat property, and I think there are a number of factors that are going to influence the growth in the future. One of the key things will be the ability of alternative capital to expand into new lines of business. The reason it's focused on nat cat is because alternative capital, these are not professional reinsurance players. They don't want to get engaged in the daily operations of insurance and reinsurance, and therefore they are very much dependent on exposures that can be properly modeled. So Nat Cat, of course, is very highly modeled. Most of the Nat Cat perils are highly modeled, and that's where they have been focused. As time develops and as the modeling becomes better and more sophisticated for other lines of business, we expect to see alternative capital expanding into other areas. Also, we have Nat Cat pools, which, as we have seen around the world, we have a number of pools, and hopefully the next pool in Egypt will be coming soon. A lot of those also need parametric covers, which are sometimes supported by the alternative capital. There are challenges facing current investors in alternative capital. It's a very collateralized form of protection, and therefore there's the issue of trapped capital. So when an event does happen, when you have a very big event or a very big loss, traditional reinsurers will pay the claims as they come, whereas with some of the products on the alternative capital, the initial capital is trapped immediately, and the investors cannot access it. And that sometimes limits, fresh or new capital coming in. And also there's a lot of work being done now on having a secondary market for some of these products, so that when those cat bonds, for example, are issued, you can then trade them as if you're in the stock market. Now that also, if we get to that point, that's also going to increase the capacity and appetite from investors. And of course, interest rates are important. When the interest rates are on the rise, then there is more competition for those investors. They might shift away slightly from reinsurance and prefer investing their money elsewhere. However, because of the correlation point that we mentioned, there is still an appetite for them. And you have to realize that for many of those alternative capital providers, the percentage of their investments that they're putting into reinsurance is very small. So even though it's representing 20% of the reinsurance capacity, it doesn't represent much for many of those funds who are involved in those areas. And finally, and I guess that's a theme across the presentation, the position of the regulator. Regulation is one of the key things that either encourages or blocks certain developments into the industry, and as regulators become more familiar, I think there will be further growth in that area. And just to make clear, when it comes to Egypt and the region, we have not yet seen the rise of alternative capital, but again, as it expands into new territories and new lines of business, that might change. And then the last but probably most important point is the impact of technology on this industry. If we look at the key challenges facing us, if we're looking at the technology, is that I think it's quite evident that the insurance and reinsurance industry is still really lagging behind other industries when it comes to the adoption of technology. There is, of course, a lot of differences from one market to the next, but we definitely have a very long way to go. The customer experience we have is still on the very low side, and I always say, when I was asked last year when we were here, what's the biggest challenge we're facing? I think my simple answer was staying relevant. Are we able to stay relevant and keep up with all the changes that are happening? The younger generation, the way they go about their lives, the way they are buying all kinds of services is changing. And we need to make sure that we are up to speed with that. And also, one of the key challenges facing the reinsurance industry is our consistently high acquisition costs and expense ratios. I mean, reinsurance industry has an average expense ratio of over 30%, and I don't see how that is sustainable. And it is extremely difficult over the years to bring down that expense ratio. And the players who will be able to adopt the technology efficiently and bring down that expense ratio are definitely going to beat the competition. Also, one of the problems we have that has a direct impact on the cost is the concept of the asymmetry of information. So what's the asymmetry of information? The problem is that the different stakeholders and the different levels in the insurance chain do not have the same level of information. So let's take the simplest example of motor insurance. I'm the driver, I know how I drive. I know if I'm a good driver, if I'm a safe driver, if I'm putting my seatbelt on, how fast I'm going. The insurance company doesn't know how I drive. They make assumptions. They look at my age, they look at my history, the kind of car I drive, and they make some assumptions. And then whatever information they're sending to the reinsurer even has less information. This asymmetry information leads to a lot of loading. Because insurance companies and reinsurance companies If they don't have the information, they just load the price further for this uncertainty. Technology is changing that. So if we look again, go back to a simple example of motor insurance. Now that I have the black box or the tracker in my car, the insurance company knows exactly how I'm driving every day. Now the information that I have is exactly the same as the information the insurance company has, and they can then choose to pass it on to the insurer. This should then have a direct impact on how we assess the risk, and hopefully, in my case, because I think I'm a very good driver, bring my insurance rates down. This also will be expanded into other areas. On the industrial side, we will get to the point where the machines or the whatever equipment we're using is reporting on a constant basis on how they are. As Mazen said, for example, on the medical side, we'll get up-to-date reports about your vitalities and how well your medical is, and that again will allow more accurate information that we can quote on. My last slide is just focusing again on the automation, and here I'll just give some examples of what's being done on the placement side. So one of the key things that the international market is focusing on, and we are seeing a lot of it in Lloyd's, is trying to move everything to electronic placement platforms. So you're not seeing, anyone who's been to Lloyd's in the past, it was all about, the brokers are walking around with their files and going to the underwriter, and everything was done manually. This is becoming a thing of the past. We're being pushed more and more towards placing everything through electronic platforms, and Lloyd's has been investing quite a bit of money to finalize this process. We're not there yet, but we're definitely moving in that direction. You also have something that has come up some years ago, which are smart follow underwriting syndicates. So you have, previously used to have an underwriter, he would be the one in the syndicate taking decisions. Now we have virtual syndicates, so you don't really have much of an underwriter sitting there, and all they do is they have a preset criteria, and once you get another syndicate with lead terms, that syndicate will automatically write a line. So you can imagine that's a syndicate with hardly any underwriters sitting there on a daily basis. They probably have a chief underwriting officer, of course, who's setting the guidelines and the criteria, but on a daily basis, this syndicate is just writing following lines as long as they're a respectable lead underwriter from Lloyd's who has given lead terms. And auction platforms, that's something that also we're expecting to see in the future, which is also linked to the alternative capital and the insurance-linked securities, where they are trying to turn these products into tradable assets. So buying and selling of reinsurance will be similar potentially in the future of buying and selling stocks. And this will happen once the contracts are very standardized, and in certain lines of business, they want to turn it into tradable investments, which will of course significantly increase the capacity and the attraction of such products. I know we're tight on time. I hope I've done well, and happy to receive any questions later on.
Thank you. Thank you, Mohamed. Like in Mazen's presentation, many interesting topics that Mohamed touched on. One interesting thing more globally is that Mohamed told us that we are maybe lagging behind on technology adoption. That is maybe some topic that we can discuss. Are we lagging back? How much are we lagging back, and why are we lagging back? But first, a question on, you touched on the parametric insurances, and as in Egypt we do have a project on a NatCat pool, and I see our friends of Morocco who has a very successful structure on parametric insurance, on non-insured people. Can you please remind us how a parametric insurance works? I believe we all know, but that's interesting to refresh our memories. Thanks.
Sure. Thank you, Mark. So parametric insurance is another form of reinsurance product that is the setup or the response to claims is quite a bit different to the traditional reinsurance we buy. Again, we see it mostly on the NatCat area, and Morocco, for example, who indeed had a very successful story. One of the covers they use for this protection is a parametric code. Just to give a simple example, we would say cat bonds. These are insurance products that are responding according to a predefined trigger. So usually, under traditional insurance, you buy the insurance, and then when a claim happens, depending on the extent of the claim, you start paying out depending on the extent of the loss, you start paying out the claims as they come. So we have an earthquake today, and then the insurance company starts reporting the losses, and then when the insurance company starts paying the losses, the reinsurers will respond to that.